Did you know there was supposed to be a Bitcoin conference this weekend in Omaha? Had they asked, you could have been the keynote speaker. Would you have said yes?
Well, they were probably crowded out by a group of people that wanted to have a conference on sewage.
Well, you called rat poison 5 years ago, right here in these chairs on Fox Business. You called it rat poison, but that was when it was about $150. Today it's $9,000. It had hit $19,000.
So it's more expensive rat poison.
But there are some people who were able to make some money. And we heard from people who are very passionate about this. And they said, oh, those guys are just trying to protect their old school investments in U.S. dollars. What do you say to that?
Well, I think these idiot booms do harm to a country. They frequently come to bad ends, and they cause economic consequences that are bad for the whole damn country. And so I like it when my country steps hard on idiot booms instead of fanning the flames. And if there's ever anything that needed stepping down on hard, it's Bitcoin.
All right. Today is Wednesday, May 19th. What a day, what a day, what a day. We entered the day with the intentions to focus on the FOMC meeting and the bonds market. That was supposed to be the story. However, in the middle of the night, something else happened and stole the show. The flash crash in Bitcoin and other cryptos. You know, other tulips, and tulips act as tulips would. And they are blaming the crash on China cracking down on Bitcoin. But that is not really it, because we heard these rumors and news that China will crack down on Bitcoin way back. What happened was a breach of important support levels, the technicals, and that triggered lots of selling. The selling snowballed into margin calls because Tulip investors are borrowing money and investing that money in the Tulip market. So all of a sudden you have a tsunami of margin calls, and in my opinion, this was the reason behind the sell-off in cryptos. But we also saw a significant recovery, at least in Bitcoin. And the question is, was that it? Are we going back to 30,000, or are we in the clear when it comes to crypto and Bitcoin? We will talk about that during the charts analysis. But when you really think about it, Bitcoin is the poster boy for the 2020 bubble, the everything bubble, the largest bubble of them all, because the rise of Bitcoin, unlike the rise in certain stocks, is being driven by global accumulation, the likes that we have never seen before. Matter of fact, long Bitcoin is the most crowded trade in the market right now. So there are lots of excesses that has to be flushed out of the market. Furthermore, American households, 46 million now own Bitcoin. What does that tell us? It tells us that a crash in cryptos, specifically Bitcoin, will impact at least 46 million Americans. That will tamper their consumer confidence, their demand in the economy, and therefore their spending overall. Because one of the reasons behind the emboldenment in consumer spending is the fact that stocks and cryptos are trading, or were trading, at all-time highs. Massive gains, and that increases the confidence within consumers to go ahead and spend. But when we see crashes, the likes we saw today, that also has ramifications in the broader market and the broader economic picture, because it tampers down inflation expectations. Now, mind you, there are many reasons behind the rise in inflation, primarily the monetary policy, but that is also fueled by consumer confidence and consumer spending. So the crash in Bitcoin is extremely important, and what will happen after the crash, meaning tomorrow and the weeks to come, will also be important. Will Bitcoin recover in a V-shaped recovery, or will the pain continue because these different scenarios will impact the market, but most importantly, will impact inflation expectations. And by the way, if you are a tulip holder, this should have been a wake-up call that you are investing in an asset with no intrinsic value at all. And the only measure for the value in the tulip market is the sentiment, the momentum, and the pumpers, chiefly Reverend Elon Musk. You are at the mercy of one man's tweet. Isn't it time to wake up and start investing rationally in real assets, not in tulips? And this is the other important take, by the way, that will determine the next direction for Bitcoin. The sentiment. Was it shaken good by the action today? We will see holders, hodlers, dumping, taking profits, saying, okay, I got enough. I had enough. Or will they be emboldened by the recovery we saw today and buy more and push this mania higher? And the tulip chasers are in good company. Not smart investors, reliable, proven investors, the likes of Warren Buffett, Charlie Munger, etc., etc. They're in the company of Rip Your Face Neptune Tom Lee, who is predicting that the price of Bitcoin will rise to $125,000. Rip Your Face Tom Lee, the fortune teller, scam artist that he is. We have Kathy Wood, Tesla Witch Kathy Wood. If you thought Tom Lee's crazy, Tesla Witch is raising the Bitcoin price target all the way to $500,000. Talk about crazy. But perhaps this is what the Holy Spirit is whispering to her ear.
But what happened is this. The Holy Spirit hit me over the head with a business idea.
You are also in the company of scam artist Drunk Michael Saylor, who, by the way, was a scam artist back in the dot-com bubble. But some are too young or too naive, or perhaps too stupid to make a simple Google search and realize that this guy is a total scam. You also have the company of Pump, the guy who's chasing you at the mall trying to sell you fake perfume. You also have the company of scumbag Scaramucci, in addition to all of the crypto scammers in the YouTube comments, Twitter comments, Facebook comments, WhatsApp scams. So you are in good company. I know. Tulip is the future, bro. It is the hedge against inflation and against the Fed and the dollar, yada, yada, yada. Give me a break. And of course, you have the coiners pointing fingers at each other. The Bitcoiners versus the Dogecoiners versus the Cumrocketers versus the Titcoiners. Your tulip is bad. No, your tulip is bad. Your tulip is causing all of this problem. At the end of the day, they're all tulips. But I am having fun watching the show. But back to the main story, out of the tulip market and back to the human being market, we were anticipating the FOMC minutes and whether the Federal Reserve will grow up and start thinking about tapering and raising interest rates. And as expected, we got nothing. They're still not thinking about. But, and this is an important but, by the way, the Federal Reserve hinted that depending on the economic data we're about to receive in the next few days and next few weeks, they might start thinking about tapering in upcoming meetings. In addition, we heard from multiple Fed personalities, mainly Bullard, who, by the way, gave the threshold of 70% vaccination rate as the point where the Fed should start tapering. And now we're getting closer to that limit. And even Bullard is saying perhaps we're moving past the pandemic and closer to that tapering discussion. Now, the market reaction was all over the place. It doesn't make sense at all. The knee-jerk reaction. And I warned you yesterday not to follow the knee-jerk reaction because what we could see is an immediate reaction right after the FOMC minutes and then a reversal the day after, right away. So we have to wait till the market digests the information it received today. What do I mean by that? Will the market focus on the fact that the Fed is letting inflation rise higher until upcoming meetings before starting to think about tapering? Or will the market look past inflation and focus on tapering because the Federal Reserve said we might start thinking about tapering, meaning will they start taper this year? And if that is the case, then the market will have different calculations entirely. For example, if the market decides to focus on inflation, then we will go back to the same playbook of yields going higher, commodities going higher, the inflationary stocks back in favor, the US dollar declining, and tech/high multiple stocks declining as well. But if the market decides to concentrate on tapering instead, then the playbook will differ because yields will still go higher. Either way, yields are going higher. If you taper, in essence, you're stopping the cocaine operation of buying bonds, and that will allow yields to rise higher. When it comes to commodities, it will be a mixed picture because part of the rise in commodities was due to the money supply, the liquidity, and the cocaine operation. Part of the rise in commodities is due to speculation. Certain commodities have their own tailwinds in terms of demand. So we will have a mixed picture when it comes to commodities. Yet understand this, if the Fed starts tapering earlier than they have anticipated, meaning this year, that will be due to the fact that inflation is getting out of hand. When inflation gets out of hand, it is getting out of hand due to the rise of commodities in part, meaning that commodities could start running higher again. And you saw right away the reaction in lumber, rebounding right after the FOMC minutes. Furthermore, if the market is concentrating on tapering, what will happen to the inflationary trade? Tapering means ending the cocaine operation that fueled the market rally, meaning that if tapering will happen earlier than we expect, at least earlier than the Federal Reserve made it to be, then as I said before, this will be a reaction to the fact that inflation is rising above the Fed's expectations. At some point, inflation becomes bad, even for the inflationary trade, because once interest rates start to rise higher significantly, remember, a lot of these stocks are heavily burdened with debt, whether we're talking about energy, industrials, or even materials. And we will see a cap of the rise in these sectors. And that will make the financial sector the only sector worthy of investing in the market due to the rise in interest rates. But you got to keep in mind that if inflation gets out of hand, that could also hurt financials, because at some point, if we see defaults from the rise of interest rates, we see zombie companies imploding all over the place, and interest rates rise higher, and the appetite of borrowing to make large purchases, for example, from the consumer side, buying homes, or from the corporate side, capital expenditures, when the interest rate rise higher, the appetite for borrowing also diminishes, hurting the financial sector. So if the market wants to concentrate on tapering, that could hurt the market entirely. Furthermore, if that is the case, then the US dollar should also rise higher. Remember in 2013, when we had the taper tantrum, that was the beginning of the bull run in the US dollar. Now, I do not expect that the US dollar will repeat the performance from 2014 because the rise in money supply and liquidity this time around is unprecedented, meaning that the long-term downward pressures on the US dollar will persist, but in the short term, tapering will relieve that downward pressure on the US dollar. Likewise, if tapering is the next destination for the market, then that will mean yields will rise higher, and that will also add downward pressure on the technology sector and the high multiple names. So the take here is, in either case, we know that yields will go higher and the technology/high multiple names will get crushed. And bear in mind, if the market decides to concentrate on the tapering rather than the immediate term where inflation rises higher, in essence, the market will revert into a stagflation reaction. In stagflation, the equities market underperforms and yields rise higher for the wrong reasons. Think about it for a minute. If the Fed is about to taper this year earlier than prior expectations, that means that the inflation problem is getting out of hand. On the other hand, if the next employment reports show that employment is not recovering as the Fed expected, and all of what the Federal Reserve has done is increasing inflation, yet employment is not recovering, paving the way for wage inflation, then all of what the Federal Reserve has achieved is stagflation. And I know the likes of Peter Schiff, for example, already calling it a stagflation. I'm not ready to call it stagflation yet, but if the next CPI report shows that inflation is picking up, meanwhile, the employment report shows that we're not creating jobs as expected, as the Federal Reserve hoped for, then that will pave the way for wage inflation. And when wage inflation hits, it's already too late for the Federal Reserve to react, and that will also pave the way for stagflation. Now, all of what I said is a lot to digest. I'm not looking to confuse you here, but the market reactions today is a knee-jerk reaction. We will have to look at the market reaction regarding yields, commodities, the inflationary stocks, tech stocks, the US dollar, and in the next few days, we will start to understand what the market is looking forward to. Is it looking forward for the immediate rise of inflation or the future of tapering asset purchasing by the Federal Reserve? In the meantime, and here is the confusion, bear with me. In the meantime, we have the technicals also dictating how the stock market is reacting. We have oversold conditions in the technology stocks, the Mania stocks, the high multiple names. We have overbought conditions in the inflationary stocks, whether it is financials, industrials, metals, etc. The market will be extremely confusing in the next few days, perhaps the next few weeks, until the technical overbought and oversold conditions are corrected. Then it will become clearer whether the market is looking forward for more inflation or a taper tantrum. You and I will know that right away by looking at this guideline, these conditions. Again, I know it's confusing, but this is the business we're in. Anyhow, we have a lot to cover, and this intro and commentary is already too long. So let's move along and cover the market performance today. And here we go. The Dow Industrial Average closing in the red, down 164.62 points, or a decline of 0.48%. The Nasdaq closing in the red, but well above the lows, down 3.90 points, or a decline of 0.3%, almost at the flat line. What about the S&P 500? Down 12.15 points, or a decline of 0.29%. What about the sector's performance? Leading the pack at number 1, but not capturing any medals because the performance was pathetic across the board. The technology sector barely in the green, thanks to the overperformance of semiconductor stocks and some software stocks. The picture was ugly in the market today, and leading the decliners, mainly the inflationary trade of materials, energy, and cyclicals. What about the advance to decline ratio for the NYSE? 29% advancing versus 69% declining. The Nasdaq, 37% advancing versus 59% declining. So it is all in all a decisive day to the downside, regardless of the fact that the Nasdaq almost finished on the flat line. Moving on to futures, what's going on here? We have a big down day in crude oil futures, declines of about 3% apiece for both the WTI and crude oil Brent. What about softs? Declines across the board, whether we're talking about OJ, cotton, coca, sugar, and coffee, all closing decisively in the red. But here it is. Lumber is making a comeback, a big rebound today after about 8 to 9 days of declines. And this is the important take. Is the market concentrating on tapering or more inflation? If the market is concentrating on more inflation, then these commodities should rebound higher. And is lumber the telltale that commodities will rebound higher? That remains to be seen. What about metals? Gold on the flat line, but big declines here for silver, platinum, copper, and palladium. Meanwhile, meats futures fared a little better. We saw gains across the board led by feeder cattle, lean hogs, and then live cattle futures. What about grains? The action is also notable in corn futures. Remember the axis of inflation: lumber, copper, and corn. Lumber rebounding higher, corn also rebounding higher, closing in the green, and we are waiting for copper. I showed you the chart of copper a few days ago. It could go down all the way to the trend line and then bouncing higher. But back to grains futures. Aside from corn and rough rice futures, we have declines across the board. Big ones for soybeans, soybean meal, soybean oil, and wheats futures. I am also paying a lot of attention to oats futures because we have the IPO of Oatly. Will this IPO be successful or not? And if it is, and we see a lot of demand, the assumption is that oats futures will start to pick up and rebound higher. Moving on to the big casino, the options market. Let's see what's going on here. The volume remains muted, well below average. Even though we saw a lot of action today, you would think that we will see lots of call options buying, creating gamma squeezes, buying the dip. That is not happening. Once again, that questions the validity of the bounce we saw today, specifically in the Mania names. Oversold bounces or legitimate dip buying. Well, the action in the options market at least not showing any legitimate dip buying. There is no conviction in the dip buying that we saw today in the high Mania, high multiple names. Anyhow, leading the pack at number 1, Apple, with about 760,000 contracts, about 62% of those were calls. Tesla, the most important name in the market right now, at number 2, with about 750,000 contracts, about 47% of those were calls. Pay attention to the put-to-call ratio. The bears could be validated, and we see a big nasty flush down in Tesla stock. But if the Johnny-come-lately bears start to pile up on Tesla, buying puts, pushing the put-to-call ratio, say to 1.2, 1.3, then you'll know that that will be a short-term bottom for Tesla. What about AMD announcing a big repurchasing program, shares buyback, which is misguided by the way. They're buying at elevated levels. They're spending more in share buybacks than what they've made in net income last year. You know, instead of spending in R&D, our companies, whether it's Apple or AMD, spending on share buybacks to enrich corporate insiders and wealthy holders. Meanwhile, the Chinese are not spending on share buybacks, they're spending on R&D to win the battle of the future, the dominance of technology. Anyhow, AMD at number 3 with about 640,000 contracts, about 68% of those were calls. Moving on to the unusual trades that took place in the options market today. We have lots of them, starting with the ticker TSLA. You guessed it, Tesla. Lots of put buying today. The bears are piling in, perhaps emboldened by the big short Michael Burry. But the big short shorted at the top. These shorts are trying to chase the move after the fact. Anyhow, they might be successful because the souffle is melting as we speak. We have crashes all over the place, and we have the magic that Reverend Elon Musk had starting to fade away. The sanity and the motives of Reverend Elon Musk are being questioned. Anyhow, they're buying the 46 puts, expiration date June 4th, with expectations that the name will drop over 18% by then. They paid about $4.15 a piece to enter this trade. All in all, bringing the total to about $4 million. What about the trade for the ticker TLT for bonds? If yields are going to rise higher, regardless of whether the market concentrates on inflation or tapering, then the TLT is dead. It's over. This is at least what this trader is saying by buying the 128 puts, expiration date July 16th. With expectations that the TLT will drop over 6% by then, they paid about 85 cents a piece to enter this trade. All in all, bringing the total to about $680,000. What about the trade for the ticker IGV, the software ETF? They're making a bearish bet here by buying the 315 puts, expiration date June 18th. With expectations that the name will drop over 7.5% by then, they paid about $3.10 a piece to enter this trade. All in all, bringing the total to about $2 million. And I did follow this trade, but I structured it a little differently. I bought the 315 puts and I sold the 300 puts just to lower my risk premium. What about the trade for the ticker KRE, regional banks? If we are expecting yields to rise higher, interest rates to rise higher, the number one beneficiary of that environment is regional banks. And here we have a trade, a bullish one for the KRE regional banks, buying the 73 calls, expiration date June 4th. With expectations that the name will rise over 5% by then, they paid about 47 cents a piece to enter this trade. All in all, bringing the total to about $200,000. What about the trade for the ticker triple Qs, the NASDAQ? Perhaps the oversold bounces have higher prices to visit. At least this is what this trade is saying. By buying the 343 calls, expiration date June 11th. With expectations that the name will rise over 7% by then, they paid about 70 cents a piece to enter this trade. All in all, bringing the total to about $300,000. What about the trade for the ticker XLV? This is the healthcare ETF. And this is an interesting one because the healthcare ETF pretty much has been weathering the storm better than any other sector of the market. But here it is, they're betting for more downside in addition to the pain we saw today by buying the 115 puts expiration date June 25th. With expectations that the name will drop over 6% by then, they paid about 70 cents apiece to enter this trade. All in all, bringing the total to about $300,000. What about the trade for the ticker IWM for small caps? We have a bearish bet here by buying the 204 puts expiration date June 4th. With expectations that the name will drop over 6% by then, they paid about $1.45 apiece to enter this trade. All in all, bringing the total to about $580,000. Continuing with interesting trades, what about the ticker FCX? Freeport McMoran, a proxy for copper. We saw massive declines for the name today as copper prices slid lower. They're making bearish bets here by buying the 37 puts expiration date July 16th. With expectations that the name will drop over 9% by then. They paid about $2 a piece to enter this trade. All in all, bringing the total to about $600,000. What about the trade for the ticker SMH? This is the semiconductor ETF. And I am looking at the second trade in the table, not the first one. They're buying the 245 calls expiration date June 18th. With expectations that the name will rise over 5% by then, they paid about $3.45 a piece to enter this trade. All in all, bringing the total to about $1 million. Now, chip stocks outperformed today, and that was the reason for the Nasdaq to close almost at the flat line. We have earnings from AMAT tomorrow, and that will be critically important for the rest of the sector because AMAT is the source, is the bullet stock. And if the sentiment turns negative against the name, then perhaps we have a peak cycle in semiconductor stocks. Lastly, what about the trade for the ticker COIN? Coinbase. Today we saw the massive drop in cryptos across the board, but also an impressive recovery off the lows. Somebody's betting that will be a bottom for Coinbase as well by buying the 240 calls expiration date May 21st. They have 2 days for this trade to work. So this is a short-term bottom play. They're expecting Coinbase to rise over 7% by Friday. They paid about $1.80 a piece to enter this trade. All in all, bringing the total to about $500,000. Moving on to the heat map analysis. Right away, you see that the inflationary trade underperformed today. Whether we're talking about energy, massive declines for the big names, the likes of Exxon down over 2%, Chevron down almost 3%, and the smaller names also got whacked. So we have a big hit here against the energy sector. Yet the bulk of the pain was in materials. Big drops here, whether we're talking about Freeport McMoran or copper, down almost 7%, whether we're talking about aluminum, steel, agricultural stocks, even gold and silver underperformed today. Likewise, financials did not weather the storm today. Down across the board, whether we're talking about big banks or regional banks. And the market all in all underperformed today. Even the big cap technology stocks, with exception to Facebook and Google. The names that managed to outperform today happen to be earnings play, the likes of Target, for example. Target reported earnings, and the name is up over 6% today. We also have Take-Two reported earnings. The name finished the day about 7% in the green. But the story was in chip stocks and solar stocks. We're talking about names like TSM, Avgo, AMD, Qualcomm, all finishing in the green, along with the bullet stocks, Lam Research, AMAT, in addition to solar stocks. Now, solar stocks got whacked severely the last few days, matter of fact, the last few weeks, and they are rebounding here from oversold conditions. Names like Sunrun closing in the green by over 4% today. And that could be, by the way, on the heels of comments from the Biden administration regarding the chip shortage and solar programs. But once again, all in all, the market doesn't look good today. And all of what we've seen today is a knee-jerk reaction of buying stocks off the bottom. Will it be sustainable or not? That depends on how the market decides to digest the information we got today. In addition, whether the sell-off in cryptos is over or not. What about the themes analysis? Starting with the reopening stocks. Losses across the board, not anything major, but again, underperformance for what's been working year to date. These are the reopening names and the inflationary stocks. We talk about the Mania stocks, the tech stocks, rebounding off oversold conditions. Well, we have overbought conditions in the reopening stocks and the inflationary stocks. These technicals have to be sorted out before we have clarity of what the market is thinking regarding the monetary policy and the macroeconomic environment. The technicals are important, but they are more important in the immediate run. But as we start to look forward, 2 weeks, 3 weeks from now, the technicals are not that important. What's important is the market's outlook regarding monetary policy and the macroeconomics environment. Back to the reopening trade, we saw big declines for AMC, and we talked about this name. When you see lots of call buying getting out of whack, that is probably a sign of a top. Likewise, we have TGX reporting earnings today, and unlike Target, the name dropped because once again, trading above the pre-pandemic highs. Lots of good news already priced in the name. What about the inflationary trade? Losses across the board. And this is exactly what we wanted to see to buy the dip in these stocks, assuming that the market will concentrate on further inflation, not on tapering right away. Take a look at the losses for WestRock, Martin Marietta, Alcoa down over 9%. Names like Deere down over 3%. Deere will report earnings on Friday. I would love to see big declines in these names, whether we're talking about Deere, UPS, Waste Management. These are the names that traditionally outperform during a high inflation period in the economy. What about the disinflationary names? Outperforming today, specifically the high multiple names, some rebounding off oversold conditions, but the names tied to Bitcoin and cryptos, whether it is Square or Tesla, underperforming today. Can we read anything here? I heard some genius over at CNBC saying that the market is reverting back to the deflationary mode. Really? Inflation is gone now because the Fed is thinking about tapering? The fact that the Fed is thinking about tapering earlier than they have told us indicates that inflation is actually a bigger problem than what's being portrayed to us. Moving on to the charts analysis. Starting with a 30 minutes chart of the SPY. The center of gravity remains 412. That is the most important level to keep for the SPY. In our discussion last night, we talked about the importance of 412, and that breaking that level will open the floodgates for the SPY. That is indeed what happened this morning, but we saw the SPY rebounding higher, closing at the highs of the day. We have few important takes here. The market is saying that the level of 406 is an important support line, and now we are in the battle between 406 and 412. The SPY did not go all the way to 412 and closing the gap from yesterday. Perhaps it ran out of time today, so we will give the SPY the benefit of the doubt to go all the way and close that gap, reclaiming 412 once again for support. If that happens, then the SPY is likely to go higher. We have a double bottom and recapturing an important support line. However, if we wake up in the morning tomorrow and the futures are down, the SPY reversing before closing the gap and before reclaiming 412, then rest assured the level of 406 will not hold as support. Zooming out, the daily chart of the continuous contract, the SPY futures. We are still waiting whether the reverse ABC formation will play out or not. And if it is going to play out, then the destination is 3,960. Now, looking at the candlestick pattern, we have a hammer-like formation, which is usually bullish. However, we have to look at the entire picture. The negative divergence in the momentum indicators of the RSI and MACD are still here, and therefore, we're waiting for a confirmation tomorrow. The candle is bullish. Will it be confirmed tomorrow? My hunch is it will not, because today's reaction in the market was sort of a knee-jerk reaction. We need to wait for the market to digest what happened today, from the crash in cryptos to the FOMC minutes and the talk about tapering, to make up its mind. The likelihood is perhaps we will see the reverse ABC pattern playing out, absent of a confirmation, by tomorrow. What about the Qs? 30 minutes chart, rebounding off 317, which is now a level of support. Not according to me, it wasn't there before, but the market asserted the importance of 317 3 times, rebounding off that level. It shows the resiliency of the Nasdaq being not ready to cross 317. And it is a battle between the positive forces, for example, the oversold bounces pushing the Nasdaq higher, and between the rising yields, which should add downward pressure on the NASDAQ. Anyhow, capturing support from 317 and going all the way to the previous support level, now resistance of 323. The magnet icon indicating the center of gravity is still at 323, pulling the chart to that level. So the Qs should be able to build on the rebound we saw today. If it fails, if we wake up in the morning tomorrow and the NASDAQ futures are down, failing to recapture 323, then the negative formations in the daily chart, the bigger picture, are playing out. What are these? Here is the daily chart of the continuous contract of the Qs. Again, we have a bullish candlestick pattern. The green hammer, it couldn't be more bullish than this. Retesting the lows, rebounding higher, and finishing at the highs of the day. However, we still have a negative divergence in the RSI. We still have a negative momentum according to the MACD indicator. We also have the possibility that the rebound in the Qs was a result of a knee-jerk reaction of the rebound in cryptos and the FOMC minutes. Once again, the market will digest. We're watching cryptos. We're watching the bond market because stocks can act funny, but the bond market reaction doesn't lie. In the case of this chart, failing to reclaim 13,300 as support will trigger a short trade, aka sell the rip. And this is a continuous contract, by the way, so by the time this video is out, you will be able to track the chart. Moving on to the IWM, small caps, also gapping lower, significantly by the way, and the IWM looks a lot worse than the SPY and the Qs, even though the IWM managed to rebound all the way to the center of gravity, the level of 212. Anything to read here? Not at all. Reversing before the gap, that's an ominous signal. Reversing before reclaiming 218 as support is an ominous signal. Fade the rip. What about the Russell 2000, the RUT, daily chart? Once again, no definitive conclusion one way or the other, but the bears have the advantage. You see the MACD indicator curling downward once again. I'm looking for the weekly closing. Will it be above 2,264 or will it be below 2,100, the line in the sand? What about the Dixie, the dollar index? Again, I've been anticipating and waiting for a pop in the US dollar, only to see the Dixie violating the very important level of support of 90. And of course, yesterday, a lot of technical analysts were calling the death of the dollar, here comes the flush down, etc., etc. Be careful, because this is, after all, tricky Dixie. It will play possum, and a lot of traders will trade accordingly, that the US dollar will flush down, only to see the US dollar popping higher again. We have a gathering of momentum in the RSI and MACD indicator. My hunch is the US dollar will pop higher again, along with yields, and we will see the pain in the stock market resuming. And if that is the case, what is the outlook for gold? Gold looks like it's topping right now, at least for this leg higher, perhaps going all the way to 1850, 1840, looking for support. If yields and the US dollar are looking to trade higher, then the likelihood is we will see downward pressure on gold. Even though the chart of gold and silver, by the way, look very bullish, and we are waiting for gold bulls to prove their theory that gold is indeed an excellent hedge against inflation. If it is, then the inverse relationship between gold and yields should terminate. And if that doesn't happen, and we don't see gold and yields rising hand in hand, then perhaps gold isn't a hedge against inflation after all. What about yields? Here it is, popping higher from the support level of 1.62 basis point. The challenge remains the level of 1.7%. Closing above that level, surpassing the prior highs, that will unlock the next rally in yields all the way to 2%. Rallying to 1.7% already acted as a tornado, crashing the NASDAQ and the high multiple names. What do you think will happen if yields start to spike higher all the way to 2%? Moving on to the TLT bond prices, and we are watching the weekly chart. So far, not looking so good. The RSI is starting to curl downward. So does the MACD indicator. That is a bad signal. And my line in the sand is 134.5. If the TLT closes below 134.5, then good night, Irene. By the way, the big short, he's also betting against the TLT because he has a large position in the TBT. The TBT shorts the TLT, and I also happen to have a position in the TBT. Moving on The VIX, what's going on here? The VIX has a reverse hammer, which according to candlestick analysts, a very bearish signal, meaning that the VIX could go down to 20 and perhaps below that number. I'm not subscribing to that because I follow the MACD and the RSI indicators, and these two are signaling that the momentum is still on the side of the VIX. And perhaps today was just a knee-jerk reaction, buying off the bottom in reaction to the rebound in cryptos and the FOMC minutes confusion. Are they going to taper? Are they not going to taper? This is what the market has to process. What about Apple? What's going on here? Gapping lower, all the way down to close a prior gap and rebounding higher. That is a bullish signal. And by the way, going all the way back to close the gap it created from gapping lower. So closing two gaps, but not recapturing 125 for support. Perhaps it ran out of time. We will see 125 being captured tomorrow. That remains to be seen. But once again, reversing before recapturing 125, the likelihood is Apple will go down all the way to 120. So 125 is the number to watch tomorrow. What about the souffle? Tesla, what's going on here? The souffle is reaching my number, 540. I'm waiting and waiting and watching. Are we going to see a rebound, or will the souffle break the support of 540, and that will open the floodgates? Technically speaking, from a daily perspective, the name is oversold, but from a weekly chart perspective, the pain hasn't even started yet. And by the way, the sentiment in this name is winding down. Not only the public is waking up that Reverend Elon is a con artist and a child, but also the fact that Ford, Volkswagen, GM, and other competitors are also closing in on Tesla. You saw Biden driving the new truck, the Ford truck.
This sucker's quick.
And honestly, the man shouldn't be behind the wheel to begin with. He should be in a rest home. But anyhow, he drove the vehicle and gave it a thumbs up. The culties are talking about the Cybertruck. Oh, the Cybertruck. That's the savior, right? Well, look at Ford, already producing an electric truck right away. It didn't even take time from the concept to the production. And that once again will question the validity of Tesla being a monopoly and ahead of the game, yada, yada, yada. In addition, we're seeing lots of accidents involving Tesla, whether it is in California, in China, they're popping one after the other. Lots of pressure on the souffle. What about the XLF, the financial ETF? Why are we talking about the XLF, by the way? Because if you go back to the beginning of the video, we talked about the different outlooks when it comes to more inflation versus tapering. In either way, it looks like the financial sector will benefit either way, or at least will be the last man standing if the market starts to crash. However, the weekly chart at least is showing severe overbought conditions. Once again, the technicals will dictate the outcome in the short term. Yields are rising higher, but financials are not responding because perhaps the rise in financials already priced in that yields will reach 2% by the end of the year, perhaps earlier. So financials should also correct or at least consolidate for a little while before resuming the rally higher. I want to illustrate to you the difference between technicals and fundamentals. The technicals will dictate the short term, meanwhile, the monetary policy and the macroeconomics environment, aka the fundamentals, will dictate the medium to long-term outlook. Some of you also asked me about certain trades I announced on Twitter. I bought the dip in Bank of America, in McAfee, and Corteva a couple of weeks ago. I already covered Bank of America's chart in a previous video, but here is McAfee. I already owned the name. I bought it back in January and February. So right after earnings, when we saw the massive dip, I started buying the dip. And McAfee recovered all the losses from the reaction right after earnings. So this trade is working just fine. McAfee is one of the few names, very few names in the technology sector that we could describe as quote-unquote value. Here's another chart, CTVA, Corteva. I bought the dip right after earnings via call options. And when I use options, I am using them properly. Options are tools for de-risking. I could have bought the dip in Corteva and committing $50,000, or I can buy a call option and commit $500 instead, and that will be my maximum risk. Doing this strategy, you're basically telling the stock, Prove it to me first. If the stock rebounds higher, recovering the losses by the expiration date, trading well above your target, your strike price, then you have the option to exercise and own the stock at the strike price. However, if the stock goes the other way and start registering more losses, then your loss is limited to the $500 or whatever you committed in the call option. The trick is to follow the technicals and have lines in the sand whether to exit the trade and minimize your losses from the call option or add to it. And the line in the sand for me, using the Fibonacci retracement levels, is 43. If the name closes below 43 on weekly basis, then I am out of the trade. I will take the loss and recoup whatever money is left in the trade and move on because the name is not ready to rebound yet. We have a negative divergence in the RSI and a negative crossing in the MACD indicator. Now, if you bought the name not via call options, let's say you committed $5,000, $50,000 buying the name, I would not recommend for you to hold and wait and see because you're buying at the top. You are better off using options. This is the beauty of trading options. And by the way, we have Deere reporting on Friday. Deere also looks like it is topping. Remember the oversold conditions in the tech and Mania names versus the overbought conditions in the inflationary stocks. Deere on a straight line, an insane run since last year. It is now reaching overbought conditions. It is reversing. It needs to go down. It needs to consolidate. This is healthy for us who are waiting to buy the dip in more inflationary names. You can use option strategies, by the way, to get paid to own the name. For example, let's say that you are interested in buying the dip in Deere, but the stock is too high right now. The technicals are not looking so good. We have earnings, and the likelihood is if these earnings are not excellent, surpassing all expectations, the stock will go down. And let's say that the level you're comfortable in buying the dip in Deere is $280. You sell the 280 puts, and if the name goes down all the way, surpassing 280, and then rebounding higher by expiration date, but not surpassing 280, you will have the choice to buy the stock at 280, and you got paid to buy the stock. So once again, option strategies are critically important in trading oversold and overbought conditions. And pretty please, there is a reason I stopped issuing trades on Twitter. I do issue trades once in a while, but not to the same frequency I used to. And the reason is, when you get it right, people will write me back and say, whoa, what a genius, how did you know, etc., etc. When you get it wrong, you will get all the hate mail, you're stupid, you don't know what you're doing, the trade went the other way, etc., etc. Again, I'm not the messiah. I don't have a crystal ball. All of what I do is use the technicals and the fundamentals to trade. And so long as 70% of my trades are profitable, I am satisfied. But also 30% of my trades end up losing money. That is the name of the game. What about the Tulip market? Because this is where the action was today, starting with the biggest tulip of them all, Bitcoin. We talked about the importance of 42,000. Once you close below that level, the floodgates will open. And indeed they did, all the way down to 30,000. What a massive crash in a single day. And this is supposed to be the new currency, the safe asset. Give me a break. But the center of gravity remains 42,000. And the chart pulled back like a magnet, all the way close enough to 42,000. The likelihood is Bitcoin is extremely oversold, so tomorrow will be a critical day. If Bitcoin manages to reclimb and claim 42,000 as support, then the oversold bounce will play out. However, if we wake up in the morning tomorrow and we see another bloodbath, the likelihood is the sell-off is not over and Bitcoin will go all the way down and retest 30,000 for support. Critical days ahead for the Tulip market. And the sentiment and the psychology is very important. You have, on one hand, the hoodle crowd who are not going to sell, but their confidence is shaken a little bit, even though by the end of the day, they feel vindicated. Look at the drop in the morning and the recovery by the end of the day. The hoodlers don't matter. What matters is those who are waiting on the sidelines, wanting to buy the dip in Bitcoin. Did they buy the dip? Are they going to continue to buy the dip? Or did the flush down scare them away? This is what will dictate the next move for Bitcoin, not the technicals. What about Doge? Doge not looking so good. Bitcoin is oversold, it could bounce. Doge not so hot so, breaking the important level, and perhaps we will see a flush down in Doge. Reverend Elon doesn't matter anymore. He can bark and scream and tweet all he wants. I think the world is waking up to the scam that is Elon Musk. What about Ethereum? I talked about buying the dip at 2,500. But guess what? I woke up in the morning and the name is trading at 2,000. So forget about it. We're done here. The likelihood is that the pain will resume for ETH if it violates 2,500 once again. And I am eyeing the level of 2,000. If it rebounds higher from that level, perhaps it will be a buy. For now, I see more pain. Bitcoin is already oversold. ETH still has a little more room to go here before we call an oversold condition. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? More important inflation indicators. We have, per usual, the initial jobless claims, but most importantly, the Philly Fed Manufacturing Index. What are we watching for? Prices paid. That is the most important number to watch for. We saw the Empire State Index, and prices paid are rising higher. What will the Philly Manufacturing Index say? Will it confirm the Empire State or will it negate it entirely? What about the earnings calendar? We have Kohl's, Hormel, Ralph Lauren, and Applied Materials. I'm looking at Ralph Lauren and AMAT as the two charts I'm watching for. AMAT, perhaps the most important name to watch for. Here is the weekly chart, and we are holding at the Fibonacci retracement level. The likelihood is, if these earnings are not super impressive and the outlook is not certain, you will see AMAT flushing down, playing the negative divergence in the RSI and the negative crossing in the MACD indicator, and that will take down the semiconductor chip stocks down with AMAT. What about Ralph Lauren? I happen to like the name, and you have the descending resistance line that was broken earlier in the year, and right away that unleashed the massive ride higher in the name. But like TGX, if these earnings are not super impressive, not living to the expectations from the stock price, the likelihood is we will see a sell-off in the name. Look at the MACD indicator. Look at the RSI indicator. They're all pointing out that the name is severely overbought. And the likelihood is we will see a correction in Ralph Lauren absent of very impressive earnings. Anyhow, that's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.